All right, so a good day to you all, and welcome to B2C tutorials. Today we would want to look at business valuation. And when we say business valuation, we are looking at the value of the business um, with respect to the number of shares or the value of the shares of the business at the end of the period, and what would constitute or what would be the reason why we would have to value the business. Note that it is only businesses that are not listed or unquoted. When we say a listed or unlisted, listed means that they can be found on the Ghana Stock Exchange in Ghana here, but an unlisted means they cannot be found on the Ghana Stock Exchange. And that because they cannot be found on the Ghana Stock Exchange, they would have to pick a similar firm and then compare themselves to such a firm. So in our introduction, it says normally shares of quoted companies are valued as per open market valuation at the stock exchange. So companies that are already listed can be found on the stock exchange, and then their value is attached to it. So market capitalization, which is the number of shares of a firm multiplied by the market price, which is also known as the selling price per shares of the firm. That is what will give you what we call market capitalization. So for a listed company, the value is the market capitalization, which is the market price per share multiplied by the number of shares in issue. However, where there is a takeover bid and the price or the offer price is in excess of the current market price of the share, it implies that the shares have been valued at the takeover bid offer price. So this is basically talking about in an instance where you have a market price, but then someone would want to take over your firm, or there is a takeover of your firm, and the person price the firm higher than the current market price. We would stand with the price the person is offering and not the market price. That is what this point really means. Why would you want to value your business? So reasons for share valuation. Share valuation is typical of unquoted companies, and it takes place when the company wishes to go public and gets listed on the exchange, and therefore must ascertain an issue price for the share issue. So if a firm wants to be listed on the Ghana Stock Exchange in Ghana, the firm would want to value the business. So the next reason is that there is a scheme of merger and each company's share must be assessed. Where two companies want to come together, two unquoted or a quoted and an unquoted want to come together and do business, the unquoted must value its share business before it can merge with the quoted, which is already valued. Now, also, there is the next reason, which is the third one, is shares are being sold. If they want to sell shares, they will have to value their business. Now, shares are being pledged as collateral for a loan. So if a firm is using its shares as a collateral, it would have to value the business. Then also the conversion of preference shares to equity shares. So if a preference shareholder wants to become an ordinary shareholder, the business must value itself, or there must be a business valuation or a share valuation so that the person can convert from being a preference shareholder to an equity shareholder. Then the next one says that for subsidiary companies, when the group's holding company is negotiating the sale of the subsidiary to a management buyout team or external buyers, the firm must also value. Now, a subsidiary is one which is being controlled by another, who is a parent company. Hence, that if the company would want to sell the subsidiary either to management or to external people, the subsidiary would have to value the business. And then would have to value the business for balance sheet valuation of minority shareholding in a private enterprise. So these are the reasons why we will be doing share valuation or business valuation. Note, for listed companies, the market price of the shares is readily available on the stock exchange at all times. Evaluation, therefore, will only be necessary for a listed company when there is a takeover bid and the offer price is an estimated fair value in excess of the current market price of the shares. So we would have to revalue a business if there is a takeover, if another company wants to take over the listed company, and then the person who is coming to take over is offering a higher price compared to what the current market price of that listed company. That is when we would only do evaluation of a business. Now, shares and businesses are valued for tax purposes. Tax legislation dictates that a business would have to be revalued for the purposes of gift tax and then capital gain tax. So even quoted companies or listed companies, the tax authority would ask them to do a revaluation again or a business valuation so that they can be able to tax them for the purposes of gift tax and capital gain tax. Now, what are the methods for valuing shares? We have four methods, or we have methods for valuing shares. The first one is the earnings-based method. Under the earning-based method, we can decide to use what we call the earnings yield or what we call the price per earnings. Then we have what we call the accounting rate of return, the discounted cash flows. Then the next method, we can look at the dividend-based method, where we would have to consider whether the dividend is constant for a long period of time or the dividend seeks to grow in the long run. Then the next approach is the asset-based method. In the asset-based method, we look at the book value of the asset or the replacement cost or the preval value. Then we also have what we call the break-up or liquidated values. Then we have the other method, which is the super profit method, capital asset pricing model, the Berliner, and then the dual capitalization. Now, out of these methods, we have focus for our class today. So we would be focusing mainly on the earnings yield under the earnings-based method. Then when we come to the dividend-based method, we'll be looking at dividend growth model. Then when we come to the asset-based method, we'll be looking at both the book value and then the replacement cost. The breakup line or the liquidated is when the company is not looking at a going concern concept. It's not looking at a going concern concept. That is when the breakup or the liquidated values would come in. But then that notwithstanding, if we have time, we'll look at the accounting rate of return, discounted cash flow, the breakup, we'll look at the super profits, the capital asset pricing model, the Berliner, and then the dual capitalization. But then now our focus would just be on the earnings yield or price per earnings, constant dividend, which we will not even look at it. If there is time, we'll look at it, but we'll look at the dividend growth model, the business valuation or book value. Then we'll look at the replacement cost, and that will be all. All right. What will make you choose the method that you have? So the choice of a particular method depends upon a variety of reasons. There are 5 reasons here. The first reason is that is the company a going concern? So if the company is not a going concern, that is when you do the what? Break up valuation. But then future earnings are irrelevant and realizable values of the net assets is important. So break up will be using the net realizable value or maybe the current market value of the asset for the computation of the breakup if the business is not deciding to go for a going concern concept. You see, one of the reasons why, one of the reasons that would influence the selection of a method to use. Then the second one is that the buyer or the seller perspective is the person buying shares or is the person selling? If the person is buying, the person is looking at the lowest possible value and should be used as a starting point. So he's looking at the method that will help him compute for the lowest possible value. And then when you look at the seller will be looking out for the highest possible value. He will be looking out for the highest possible because he would want to make a capital gain. So once the seller was a buyer, he wanted to buy, and now whatever amount that he bought it for at the lowest, when he's selling, he's looking at increasing it. And then once the price at the time he's selling increases, we can boldly talk about what we call shareholders' wealth maximization. He has been able to maximize his wealth by the value of this business going higher compared to how much he acquired the business for. That is the second point. Then the third point is that what percentage of the total shareholding is to be bought? That is for the controlling interest. The ability to sell the asset of the company means both the asset and the earnings will be of interest. So if you are looking at parent and subsidiary, the best for them will be earnings and then also the asset model for the computation, the asset based and the earnings based. And then the next one says that is the company quoted? A private company would usually be valued at a discount against a similar quoted company due to marketability of its shares. So if I am already listed and you are now coming, you wouldn't want to sell at the same price that the company already listed, is selling for. So you would want to sell a little bit less. So you would like to use the discounted under the earnings yield, earnings based method for your computation. And then the last one, how marketable is the shares? This can have an impact on the method applied and the solution. So the first method which we would want to be looking at is the price per earning. Price per earning. So this method is appropriate in valuing the controlling interest in a company where the owner can decide on dividend retention policy. So you can best understand this model when we pick up an example. And the more we solve examples, you would understand better and better. Now, have this in mind that before you can value a firm, using the price per earning and the dividend based model, you need a similar company which is already listed. But then when you are doing that of the asset based, you need to find the book values of the assets of the firm. But then if you are using the first two methods, that is the earnings based and then the dividend based model, would require the presence of a firm that is already listed. So in our examples, I would explain how to go about it so that you get the concept and appreciate whatever we are doing. Okay. All right. So just like I promised, this is our question and answers for business valuation. So let's take the first question. But before then, let's read the requirement. So the requirement states that compute a range of valuation for the business of QHL using the information available and stating any assumptions made. Use the following methods for the valuation. 1. Net assets, that is the assets based. Price earning method, that is the earnings yield. And the dividend growth method for our computation. Then B, comment on the strengths and weaknesses of the methods used in A and their suitability for valuing QHL. Now, who is QHL? Let's read our question. This is an ICA question, May 2013. Question number 4. Quality Handicraft Limited, QHL, produces handicrafts for both local and foreign companies. The company was incorporated in the year 2008 and now employs about 150 craftsmen. The shareholders of QHL mainly comprises the original founder and close family members who would now like to realize their investment? Now want to realize their investment, and an I word, like to realize their investment. In order to arrive at an estimate of what they believe the business value is worth, they have identified a long-established quoted company, that is Swama Handicraft Company. So you would realize that QHL is not quoted, but then SHC is a quoted firm. So Swama Handicraft Company, SHC, which has similar business, though it also produces for the European market. Summarized financial statistics for the two companies for the most recent financial year are as follows. This is for QHL, this is for the quoted company SHC. It says that the issued shares, the shares they issued were millions. So QHL issues 8 million shares, then SHC issues 20 million shares. Then the net asset value, which is in Ghana cedis and in millions, QHL has net asset value of 14.4 million Ghana cedis. SHC has 30 million Ghana cedis. Then the earnings per share, which is in pesos, QHL has 35, and then SHC has 28. Then we come to the dividend per share. Dividend per share. QHL has 20, and then SHC has also 24. The debt to equity of QHL is 1.7, and then that of SHC is 1 to 6.5, sorry. The share price as quoted on the stock market is 160. So remember that QHL is not listed. That is how come its share price is 0. But then SHC is quoted. So they would have a market price for their shares. All right. Then the expected growth of the company in earnings is 5% and 5% for both. So this would be for dividend growth. This would be relevant for computation. This will be relevant. This is irrelevant for computation. This will be relevant. This will be relevant. This will be relevant. And this would be relevant. Why? Let's read on. Additional information. The net assets of QHL stated above are the net book values of the tangible non-current assets plus the working capital. However, a recent valuation of the buildings was 1,500,000 above the book value. So a recent valuation, meaning that they've done some valuation and they realize that the difference between the current amount and then the fair value is 1,500,000. And that we pick the difference and then we'll add it when we are doing the asset based method. So let's go on. And then it says that an investment held which is designated as available for the sale with a current value of 1 million is fair valued at 1,100,000. Here, we've been given a current amount, we've been given a fair value, and we ought to find the difference between the current amount and the fair value to be able to adjust our net asset. So these figures are giving us for us to be able to adjust our net asset because we'll be doing the net asset valuation model or the net asset based model. Okay. Or the asset based model. All right. Okay. Having said that, it says that due to a dispute with one of their clients, an additional allowance for bad debt of 750,000 could prudently be made. So bad debt means that you are losing money, and then it is also part of your income at the same time as part of your current assets. So you have realized the bad debt, which would affect your net asset. So this would affect your net assets. This would affect your net asset. But this and this is a fair value increase, which is like a gain. Hence, it is going to affect your net asset positively. But this would affect your net asset negatively because it's a bad debt. So we'll now have to less. Now let's look at the next item and see how we can best understand. It says that an item of plant with a current value of 800,000 cedis is assessed to have a value in use of 760,000 and a fair value less the cost to sell of 780,000. Now here, what are we going to do? We are going to test for impairment. Already, you could see that the difference between the current amount and the value in use is 20. So current amount minus fair value in use, fair value would give us a price of about 7 minus 8, 80 minus 7 is going to give me 20. And then also the cost between the fair value and that of the value in use, the current value and the value in use is 40. So current value or current asset minus the value in use is 40,000. Now, the difference between if you had used the asset and you had sold the asset is a loss. If I sell it, I'll be losing 20. If I also decide to use it, I'll be losing 40. Ideally, I'll be losing 20,000. So this means an impairment or a loss on the item plant. So there's a loss on the item plant of 20,000, which would negatively affect our net asset when we are doing our book. So the current amount and the value in use gives a difference. So if I decide to use the asset, this is what I get. If I decide to sell it, this is it. Meaning that I'll be making a loss, great loss of 20,000 on it. Now the growth rate should be assumed to be constant per annum. QHL, earnings growth rate estimate, was provided by the marketing manager based on the expected growth in sales adjusted by the normal profit margin. SHC's growth rates are gleaned from press reports. The dividend yield of SHC approximates its cost of equity. We come back to our requirement. So we are supposed to compute a range of valuation for the business of QHL using the information available, stating any assumption made. Use the following method. So the net asset method is for us to start by writing the net asset of the unquoted companies, the unquoted company. So books of QHL, in the books of QHL, you write that, you underline it. Then you come down and see net asset method. So we have the net asset method. And then once we have the net asset method, we pick its price of the net asset method. So look at the price of the net asset. It's valued in millions. And this is it for QHL. So once we begin with that, already you have the net asset. You've written your currency. So the net asset valuation, the net asset method. Then you underline it nicely. Note that accounting purposes would give you text, so you need to write out things that will give you a text, though we are not looking for 100%. And then your Ghana cedis with million, because it's in cedis. Ghana cedis with million. You're likely to score the text for examination purpose. Okay, so you do it same for this place too. Forgive me if I'm not fast because mine. All right, so the first item would have been the net asset value at the beginning. So net asset value That is for the unquoted company, which is QHL, of 14.4. Don't forget, we've already hung the zero. Okay, so we go back to our adjustment. I told you that this is a fair value adjustment, which is positive. So we need to add it. Okay, so fair value of building or building adjustment. Adjustment, so we have building. And that is 1,500,000. That should be 1.5 because we've already hung the millions there. 1.5. Then we come down to the net asset. It says investment was fair value. And I've told you the difference between the carrying amount and the fair valued amount would be the adjustment. So investment is also positive, a difference of 100,000, and 100,000 would be 0.1. 0.1. Okay. So the next item, which is a bad debt. Bad debt is a loss to you. Bad debt. You lose a 0.75. All we are doing is we are converting them into millions. 0.75. It's a loss, so we put them in brackets, which means that we are lessen. Then we have the next one. So impairment on plant or impaired plant, because you've lost 20,000 on it. Plant. And that is also 20,000. So 0.2, 0.02, sorry. Then you find your total, and that will give you the value of your item. So quickly, you should have 15.23. That is 14 plus this should have given you 16. 16 minus 0.75 should give you 16 minus 0.75 should give me 15.25. 15.25 minus 0.02. That should give me 15.23. Now, that is the value of the business with respect to the net asset. So net asset, then the adjustment, then they come as follows: the building, the impairment loss in the plant, impaired plant, and all that have you. So we are done. So this is the value of the business with respect to the net asset model. Now, what is the value of the company with respect to the earnings, price per earnings, price per earnings? So price per earning. Now, here I would want you to pay attention to me closely. What is the formula for finding price per earning? The formula for finding price per earning is basically the market price or the price. So let's call it market price is equal to price per earning share, price per earning ratio, price per earning ratio multiplied by the earnings. So price per earning ratio multiplied by the earnings of the firm. Okay. Multiplied by the earnings of the firm. Now, this would be for the unquoted company. Mind you, you only know the earnings of the unquoted, and then you don't know the price per earning ratio of the unquoted. So we need to determine, so this is for unquoted. This formula is to determine the price per earning for the unquoted. But before then, we need to find that of the price per earning ratio of the quoted. So we would just come and find price per earning ratio of quoted. And as the name goes, of the quoted. Now, how do you do that? Please pay attention. It's just about you interchanging the formula. Now, if this multiplied by this will give me the market price per share of the unquoted, how can I find that of the quoted? To find the price per earning of the quoted, it is basically the market price of the quoted company divided by the earnings of the company. Divided by the earnings of the company. So this market price is for the quoted, and this earnings is for the unquoted company. So let's go to the how to determine for the quoted, and then let's look at what we have to do. So you realize that for the quoted, the market price or the share price was 160 Ghana pesos, and then the earnings per share was 28. So for the quoted company, we would have 160 Ghana pesos divided by 28 Ghana pesos. All right, this would help you find that of the quoted. Please let us do this computation together. What is 160 divided by 28? This is 5.71. 5.71. 5.71. So this is it, 5.7. So we have 5.7. You can add a 1 to two decimal places. Now 5.714, the quoted company. Now, the quoted company is not the same as the unquoted company. Therefore, we cannot assume the same price per earning ratio. We can assume the same thing for the unquoted company. So when you see it multiplying like this, what you need to do is that when you find the price per earning, you need to adjust it downwards. If the company or if the question did not give you percentage, we need to adjust it downwards slightly. So look at it. It stated it clearly in the question that I saw this thing somewhere here. Growth rate of the company, marketable since adjusted by now. So stating any assumption in the requirement, use the information available and stating any assumptions made. So we have to state price per earning ratio lesser. Now note that in business valuation, we can't have one answer altogether. So I can decide to state it lesser than the 5.7, to say 3, to say 2, to say 1, to say 0. To say 1, but then I can't say 0. So anything lesser than 5.7 is what I need to adjust the price per earning ratio to. So I need to adjust it less when it comes to price per earning, because that will be multiplied. When we go to the dividend, we need to adjust it a little bit up because that will be divided. So whenever it is multiplying, we adjust the quoted company's figure downwards. But then if it is dividing, we adjust the quoted company's figure upwards. Okay, so to say, just say adjust PE of quoted company to PE ratio of quoted company to Let's use 3 quoted to say 3. Now, it is only this one we have now determined for the unquoted. Now, how do we determine the earnings? We were given earnings per share in our company. But don't forget that this earnings per share is basically the profit of the organization. Now, in the profit of the organization, we've been told that there is an impairment of 0.2, and then there's also bad debt of 7.50. So we need to adjust the earnings of the unquoted company before we can present it. Other questions, they can give it to you directly without you necessarily adjusting. But with this specific question, the earnings of the of the unquoted company must be adjusted. And so how do we adjust it? We simply pick the earnings per share, multiply by the number of shares they have. Then we now come and less the 2 impairment and then the bad debt from it. So let's look at the answer directly from here without me not necessarily writing it. So it says the earnings. It picked the 0.3, that is the 35 pesos, multiplied by the number of shares the company has, and then we produced this amount. So we made our adjustment, that is the losses that affects the profit and loss account. Bad debt affects the profit and loss account. Impairment also affects the profit and loss account. But then fair value adjustment of equipment only affects balance sheet and does not affect your profit and loss accounts. That is how come we list them. So this becomes the earnings of the firm. So in order for me to find the market value, I need to multiply the earnings that I have realized, by the adjusted price per share earning ratio. So we realized 2030. So when I multiply this by this, I'm supposed to be looking at 2030 multiplied by 3. That should give me 6090. 606090. All right. Please don't forget this is in millions. But this time around, they hanged 3 zeros. So if we were hanging the millions, it would have been 6.09. 6.09. So let's stick to the hanging the 3 zeros. Hanging your 3 zeros. 6.309 cedis. 6.3 point 6.09 million. Just like we have above there. For this, we had 15 Ghana cedis, 15.23 million. So we've determined that of the net asset, and we've determined that of the price per earning ratio too as well. Now the next one for us to determine is the dividend model. So the dividend, we treated something as far back last year, dividend model in business finance and then investment portfolio, which I know majority of you here have forgotten, but don't worry. So you realize that in the dividend, we were supposed to determine the K, which is the percentage. Okay, it was supposed to be your dividend over the market price of the share. Now, in this business valuation, it is this P you are looking for. Don't forget, this is when dividend is constant. But then we said that when dividend is not constant, to find a key, we said it was the initial dividend multiplying 1 plus the growth rate in the question, all divided by price, the market price plus the growth rate. Now here we are looking for P. So we ought to make KO, we ought to make P the subject. How do we make P the subject here? We need to just multiply through by P. So you realize that K percentage will multiply the P as 1. I'm just helping you determine the formula in case you forget. This whole equation will multiply P, D0, 1 plus J is multiplying P, and the growth rate would also multiply P. So P times the growth rate. Okay. Now, having done this P cancels this P. You now have K percentage P is equal to DO 1 plus growth rate, all plus P multiplying J. We group like terms, so P will go here. So I'll have K percentage of the market price minus P of the market price, P multiplying market price multiplying the growth rate, which is equal to the dividend, initial dividend that is yet to grow. All right. Now I'm making P the subject, so PP here. So I'll bring P outside the bracket. Then I would have my growth rate minus my K minus the J, all is equal to DO 1 plus J. So the market price, which is the P, will stand alone, and then we'll have DO 1 plus J, 1 plus J, all over K minus J. Now, this is in the case whereby there's a growth rate. Now, forget not that when we say the dividend-based model, this is what we are supposed to use to determine the actual thing. This formula is what we use to determine the value of the business. But then the question I have for you is that we are finding that of the unquoted company. And since we are finding that of the unquoted company, we would first require the K of the quoted company. This dividend and its growth rate are for the unquoted company. This you pick for the unquoted company. But in our question, we've been given market price. We've been given this of the quoted company. And then we've been given dividend too of the quoted company. So why don't we use this to ascertain this and then now come and adjust the key and then come and solve for it? So in our dividend question, which we are going to use this format as the formula, we need to first determine the K of the quoted company. So the formula says that P, let me rewrite the formula again for you. Okay. The formula says that C, to find the market price of the dividend using a dividend base, this dividend that seeks to grow, D1, we all know D1 is the dividend that has grown, should be divided by K, which is the dividend yield or the discount minus J. How do you find D1? This is for unquoted. This is for unquoted. And I am saying that before we can do for the unquoted, we don't know unquoted percentage. So we need to use the quoted to find the unquoted percentage. So we come and do for quoted by finding K, which K will be is equal to dividend divided by the market price of the quoted company or listed company. Okay, if it makes sense, what is the dividend of the quoted company? let's pick the dividend of the quoted company. It says dividend per share of SHC, which is the quoted company, was 24. Okay. What is the market price of it is 160. What is 24 over 160? 24 over 160 should be 15, 0.15. And I am saying that, see, this K here can be found as a division. And if it is dividing, we need to increase or adjust it upwards. Please bear in mind, when it was multiplying, we adjusted the price per earning downwards. But then if it is dividing, we need to adjust. The K is going to divide, so we need to adjust it upwards. So say adjust upwards. Adjust upwards. So how do you adjust upwards? This is in the sense, this is 15. In terms of percentage, will be 15%. So you can say 20%, which is the same as 0.2. We are adjusting 15 upwards. So we say 0.2, which is the same as 20%. The 15 is the same as 15%. The K is always in percentage. So whatever you have, you multiply it by percentage, and then it should be 15%. So we have adjusted it upwards. Now, our main concern is to go and substitute the 20% in the formula. The growth rate is already 5. This dividend here is not a dividend that has grown for the unlisted company. So all we need to do is to bring our market price for the unquoted company, adjust the dividend that is about to grow to 0.21 plus the growth rate. We need to adjust it plus 5%. All divided by the 20% we just solved. 20%, we have adjusted it, minus the growth rate of 5%. Please, the MP for the unlisted, we are just using this formula. D1, all we know is that D1 has always been the initial dividend, bracket open 1 plus the growth rate, which you can solve and find the answer. Now, when you do this, you found the market price using the dividend-based approach. Okay, so what is the market price here? We have 20 bracket open, 0, 15, 1 plus 5% bracket close, 20% minus 5%. This is 140. 140. 140 pesos. So once you are done, so 140 pesos in terms of cedis would have been 1 point what? 4 cedis, 1 cedi, 40 pesos. Now, this is giving you 1 cedi, 40 pesos. The dividend-based formula is giving you 1.5. 1.4. The earnings, price per earning is giving you 6.09. And that of the other one is giving you 15.23. So you are supposed to select the one with the highest and then advise shareholders on it. So the dividend was supposed to be multiplied by the number of shares of the company. So what is the number of shares of the company? So we multiply the dividend by the number of shares of the company. So multiply. So when you are done, you just multiply them by the number of shares of the company. So 6.09 multiplied by the number of shares of the company. And then also all right, so the value, which was 6.09 million, was for per share. And then this one too was for per share. So you could realize that this is for the entire share business. So This is what you need to multiply by the number of shares of the company. 6.9 per share multiplied by the number of shares of a company. What is the number of shares of the unlisted company? It was 8 million. So 6.09 of 8 million shares. This is per share. Per share multiplied by 8 million. So let's say 8 million. Let me do it 8M. So 8M times 0.6.09. 6.09 times 8 million should give me 48.72 million cedis. So this is what would have been picking rather than the 6.09. And this was also 1 cedi per share. 1 cedi 40 pesos per share, multiplied by the 8 million shares that we have. So what is 1.4 times 8 million shares? That is 11.2 million. 11.2 million cedis for the entire shares. So for the entire shares, this records 11.2 million. For the entire shares, this is recording 48.72. And for the entire shares, this is recording 15.2. So which would you advise management to go in for? You expected to advise management to go in for the one with the highest. And so this should, wait. Okay. Let's recompute this one again and see. This is in pesos. This 28 was in pesos. So 28 pesos. So pesos divided by pesos. This should have given me, this is in pesos. So this is a 3 pesos. 3 pesos. I adjusted it down to 3 pesos. And so if I adjusted it to 3 pesos, 3 pesos multiplied by the earnings. So you can take it from there. So let's go by this, and this. You can actually take away the millions and compute it with zero figures. All you needed was a concept. So this. When you compare, you realize that the net asset valuation was the highest. So your comment to them should say that the valuing a company on the basis of its assets value alone is really appropriate if it is to be sold on a going concern basis. Exceptions would include property investment companies and an investment trust. The market values of the assets of which will bear a close relationship to their earnings. Knowledge of the net asset value, you can read on the comment. Our focus is to look at how to do the computation. And then the comment goes on and on and on. If I decide to read, we will not finish today. But then, whatever you advise management, if they are buying, they should buy at a lesser price. But then if they are selling, if they are buying the firm, they should buy at using the price per earning. But then if they are selling, they should sell using the net assets, which would give them a gain on their shares. If you have more questions, text me, call me, contact me for more clarification. Thank you for joining, and then hope to see you around. Have a lovely day and a bye-bye.